Fundamentally, each side treats the other's core discipline as overhead. So traditional infrastructure people treat blockchain as a database replacement project. Crypto-native builders assume the technology is the product. The technology was never the hard part when it comes to adoption within institutional. It's connecting the blockchain to systems institutions already run. So all the questions are not about the technology. They're going to be focusing around the legal aspects of the activities that are being conducted on that technology.
Would institutions ever actually benefit from decentralization?
The flip side is of what institutions do not want is decentralized control.
A lot of great work, hard work is happening behind the closed doors. And then, when we see all this announcement, they just come out of a sudden of nowhere. But then we understand that, there's been maybe years that those institutions have been working on a particular initiative.
You need to have really robust executive sponsorship. And so the strategy and the execution needs to be owned by the most senior levels of the organization.
Hi everyone, and welcome to Onchain Honestly,
a podcast about what actually works in crypto as a business.
We're long-term believers in this space, and we want more honest conversations about what's changing and why.
So we explore real models, practical outcomes, and what it takes to build something that lasts. Hi y'all, and welcome back to Onchain Honestly. We are your co-hosts, Kaisa and Alenka, and today we are really glad to be joined by David Newns. David, thank you so much for taking the time, and I'm very sure that our listeners would love to hear a little bit more about your own background and what you are up to recently.
Thank you, Kasia, and a real pleasure to be on and a privilege, Kasia and Alenka. Thank you very much for the invitation. So I have spent the last 4.5 years as the CEO of Six Digital Exchange, which is the first blockchain-enabled financial market infrastructure, headquartered out of Switzerland, a fully owned business of Six Group, the FMI there. Prior to that, I spent 25 years in the capital markets, really at the interface between innovation and technology, and specifically the adoption of that technology within the regulated space. So 14.5 years at State Street, running their independent multi-bank trading platforms on the FX side. And then prior to that, a number of startups I was involved in that goes back way back when.
It's like that's very extensive background, and I think the conversation that we can have today is really also about the bridges, being built between the worlds. But also we're hoping to have a lot of different examples and case studies by your side. So maybe just to kick things off, as you mentioned, you have been in State Street, then also in TLT market infrastructure and at SDX. What does each of these generations of infrastructure misunderstand about each other?
So I think that's a good question. So I think fundamentally, each side treats the other's core discipline as overhead. So traditional infrastructure people treat blockchain as a database replacement project and price it as cost compression and justification, which misses the point in that the genuinely new value is in collateral mobility, balance sheet velocity, capabilities that the current tech stack cannot offer at any price. Crypto-native builders assume the technology is the product, but as I've mentioned in other contexts, the technology was never the hard part when it comes to adoption within institutional. It's connecting the blockchain to systems institutions already run, and doing that underneath a single license. That is the challenge. I think also crypto native tends to read netting and credit intermediation and tiered access as legacy inefficiency, when those exist because full pre-funding is capital inefficient enough to prevent deep liquidity forming. And I think each side underrates the other's risk management. So I think traditional firms underrate how robust and well-audited deterministic execution is. And crypto underestimates why margin calibration, default management, and discretion under stress sit with accountable entities. So when I see how these two technologies are coming together, and from my experience uh, at Six, I feel that like the end state is a sort of a reconfiguration of financial market infrastructures rather than disintermediation as a result of the technology being incorporated. So institutional redesign with deterministic functions in code and accountability in legal entities.
I think crypto people or the crypto space in general has been very excited that institutions are coming on chain, and it's sort of this keyword or phrase
Mm.
that's been thrown around, and it's driven quite a lot of price action, I think as well. But can we actually dive a bit deeper into what does that phrase mean? Because you have a lot of experience in bringing products on chain and building these relationships and bridges. So, from your own experience, and if you could give maybe a couple of examples as well, what does that phrase, institutions coming on chain actually mean for a bank or a regulated infrastructure provider?
So I think institutions coming on chain, well, inside an institution, it means essentially a series of gates to be cleared, and none of them technological, as per my previous point. So it's the legal classification of the asset, custody and fund eligibility for that institution type in that jurisdiction, accounting and capital treatments, and then integration into existing order, risk management, and settlement systems. So if I was to take a couple of examples of what production actually looks like. So my former organization, Six, so SDX. So Six Nest and Citibank went live a couple of months ago with tokenized depository receipts, giving institutional investors access to private company shares. So that's regulated production with real assets, which I think is a long way from the performative announcements of, say, 2 or 3 years ago. So that enables access to those tokenized shares for the broadest possible set of institutional participants. So, and that is because of what those holding those tokenized depository receipts actually means for those organizations from a legal perspective, from a settlement perspective, from a custody perspective. Um, the other big development that I'd point to would be the SEC's December no action letter to the DTC, which permits tokenized settlement of DTC custody assets inside the existing perimeter. So that's on rails. Every US asset manager already uses. No issue around qualified custodian. So the result is that it reaches that access that the buy side is actually gated on, qualified custodian, existing perimeter, and so on. Uh, so that I think is a really massive step forwards, and actually, it is more substantial as a step in the direction of the adoption of digital assets, and even something like the market structure bills like Clarity are going to provide for the broadest possible set of participants in the institutional space.
David, and based on your experience, how does such a change usually start within an organization? Is it a particular person that's driving this change? Is it a group of people? Who does it? How does it emerge at all?
Well, I think that for these for a within an institution, um, for a project to be successful in the digital asset space, one of the most critical aspects is going to be um, the governance of that organization and the executive sponsorship. So, who actually owns that initiative? So, these are um, such fundamental changes to the way that an organization will carry out certain processes and touch so many aspects of the organization. As I mentioned before, but there are legal implications. There are middle and back office, so there's operational implications. There's risk and compliance functions. All these, there's a whole slew, a really broad set of parts of an organization which are going to be touched by any project related to digital assets. That means that you need to have really robust executive sponsorship. And so the strategy and the execution needs to be owned by the most senior levels of the organization. and it needs to be considered to be so. uh, I think it needs to be considered within the context of a broader adoption of the technology, rather than this is a point project like an IT initiative that might be being driven sort of more from the ground up within the organization. I think much like artificial intelligence as a project for an organization, it needs to have a more holistic perspective, given the broad number of or broad sort of set of functions that the that any project within the space is going to touch.
You clearly mentioned a few reasons based on which institutions and organizations are taking this decision to come on chain. Could be cost efficiency, cost optimization, right? Could be just this will to not fall behind the competitors who are also looking into that direction. Could be client demand, and so on and so forth. Regulatory tailwinds, I think, is a crucial pillar there as well. Can we say that some of those reasons um, are more significant than the others? What are you seeing recently in the market? What are the ones that have most weight when taking this decision in terms of launching any blockchain related project within a traditional institution?
So we're beginning to see a kind of coalescence around certain use cases. I think that collateral mobility is one that is sort of increasingly being seen to be um, the benefits are being seen as being as obvious and substantial. So uh, the fact that within so it's not it's not simply that the blockchain is considered as as a faster version of a database, but the instantaneity that you have in sort of instant settlement, and how that translates into the sort of immediate collateral sort of mobilization. That is one area that we're seeing substantial traction within within the institutional space, because it's quite clear that if you can mobilize and if you can reduce the amount, so mobilize collateral more effectively, reduce the size potentially of your of liquidity buffers, and have your collateral, the capital, um, lying dormant for less time, so put it to work more often, then that has a direct benefit to participants in the space, to participants who depend upon that for their for lending, for trading, and so on.
And when you're saying this, do any particular examples pop up in your head in terms of any practical use cases recently?
Yes, well, there's a couple that there is sort of instantaneous repo, and we've seen there are in production applications such as Broadridge's on Canton being a good example of that. But at the same time, I think we'll see that the adoption um, of uh, of collateral mobilization, leveraging stablecoins and stuff, and so on um, within the financial market space and institutional space for clearing and so on, is going to be something that we'll see an increasing sort of demand for over the coming months and years.
Right. I think within that DTCC pilot that you mentioned a few minutes back, we'll definitely see something of this type being
Absolutely.
tested as well.
And they've been very vocal about how they see collateral mobility as being the sort of the most tangible and the most substantial initial use case for the tokenization of securities.
So I was also wondering, when we talk about all of these different products and pilots coming on chain, it's also no secret that institutions are very selective, right? You mentioned Canton as a good example here, but they are permissioned chain. There's, KYC, um, like all of these elements able to be coded within the language. But like just sidestepping this element a little bit, would institutions ever actually benefit from decentralization?
So this is an interesting topic, because it really comes to the sort of the heart of of why institutions are will have historically struggled with the technology, and it's not so much related to it comes down again to this notion of accountability and compliance. So the shared source of truth, the collapse in reconciliation, and I think and a sort of robustness against unilateral alteration. So institutions will benefit absolutely from that. Uh, the notion that in a conventional database, the operator holds administrator rights and often controls the change logs, whereas under a decent consensus protocol, retroactive alteration would require coordinated agreement across a significant share of validators. Whereas, so that's a genuine, stronger property. I think also the ability for supervisors to verify directly on chain rather than through data prepared by the entities that they supervise is a major upgrade in oversight. But the flip side is of what institutions do not want is decentralized control. So they need an accountable operator, uh, and so someone to call at 3 in the morning when everything's gone wrong. Um, and decentralization can sort of invert in on itself as well. I think through reverse dependencies, and we've seen this in the crypto native space where um, a dominant stablecoin or Oracle can quite effectively acquire veto power on a chain's upgrade policy. So you end up with concentration risk rather than the absence of that as a result of as a result of actually of the theoretical decentralization that chain has comes with. So I think there are clear benefits, but at the same time, there are also challenges that decentralization throws up in front of an institution, and sort of pure permissionless decentralization is therefore going to be really problematic.
David, and what are the other challenges or concerns that you're increasingly seeing on the institutional side? So we know that, for example, within those discussions about the Genius and Clarity Act in the US, yield on stablecoins is just one example of those concerns of banks and other financial institutions, because they essentially see it as a risk to bank deposits, which is really their bread and butter. What are the other concerns you're seeing? Maybe even focusing on the European market, which I assume is a bit more adjacent to what you've been doing throughout your career.
Concerns in terms of uh, well, the concerns are really around how do I leverage the technology? So the technology itself is not necessarily the challenge. The challenge is what legal activity am I allowed to carry out on this chain? Who is my counterparty on a decentralized application? What does this asset mean legally and from a custodial perspective? What does it mean? What does it mean if you as an on-chain provider um, uh, are providing a service to me? What happens with in the case of you or of you going of you suffering from financial stress if you go bankrupt? What are my recourse in that particular perspective? So and I think really substantial questions like where is settlement finality legally defined, and subsequently how does it hold in our insolvency regime? So all the questions are not about the technology. They're going to be focusing around um, the legal aspects of the activities that are being conducted on that technology. So I think that if I look at a if I look at sort of on-chain businesses that are approaching institutional space, it would be it would be things like how's your operation, sort of how's your operational setup? How do you integrate with our order management system, our custodian? How do our reconciliation projects? What does your rulebook say? Who holds administration keys? Uh, and what's your recovery and wind down plan? And so only after all of those sort of uh, rather um, non-technical oriented questions would anyone ask what chain do you run on?
Well, now we have Maker in the EU, we have the Genius Act in the US. Have you personally really seen any significant changes? Have you seen significant progress and real practical outcomes?
Oh, absolutely. Look, and that I think is exactly my point. Is that when the regulatory, the regulatory environment, the framework is clear, when the legal framework was clear, then institutions are very enthusiastic about embracing the benefits of the underlying technology. So with Mika in the in the UK, with Genius in the US, with the digital security sandbox in the UK, with the DLT pilot regime in the EU, uh, all these actors as the biggest possible catalyst for the adoption of the technology in the institutional space. So, and we've seen that through in ever increasing initiatives being launched by the rise of adoption of stablecoins that are now sort of reaching the 400 billion market at this point in time. And I think that's very much driven by confidence around the technology and confidence around the activities that's given by the fact that you can now within the new regulatory regimes be compliant when it comes to the adoption of that. So every week we hear new and exciting initiatives being launched, which just even 2 years ago, even a year and a half ago, prior to the US administration's change, would have been really absolutely sort of eye-opening, and now they're becoming sort of par for the course. So uh, with the regulation and the anticipated regulation, it's a massive tailwind that's driving adoption and driving enthusiasm within the sector. So I think that is an unassailable uh, trend that we're seeing within the industry. That's very much one that's driven by regulation.
Let's maybe touch upon some practical examples here. What are these projects, these announcements that you're most excited about that you think will really drive the change? Maybe let's take some recent ones that come to mind.
Well, as I mentioned before, I think because none of the regulations actually so far touch. So I'm gonna kind of backpedal a bit because um, Genius was great for enabling the adoption of stablecoins, as was Mika and for stablecoins for assets in the EU. But as I mentioned earlier, I think the DTC no action letter from the SEC is one of the most substantial developments that we've seen because that enables the full stack that the institutional space is required to leverage um, to be tokenized, or to be enabled through tokenization. So you get legal clarity when it comes to what the security is that you're ultimately holding, which is very different to what we've seen so far from the retail orientated tokenized shares offerings that we've seen, which tend to be there's a wrapper that is tokenized of an SPV, or it's a derivative, and the your ownership of the underlying is not actually where what you're granted through the token. Rather, it's just exposure to a counterparty who holds ultimately those tokens in custody somewhere. But that's something that doesn't work for the institutional space. The DTC no action letter does work for the institutional space. So I'm very excited to see what happens as a result of them going live in second half of this year with that tokenization initiative. So I think that of all the things we're seeing out there, I think that that's really substantial. Um, since leaving Six, I've become involved with two projects here in the EU and the UK. I'm joining the board of Axiology, which is a one of the four license holders under the DLT pilot regime, which is digital securities. What they're doing is really exciting in terms of the changes and the evolution that we're seeing within the security space in the EU. And also, I'm an advisor to BPX Markets, which is a regulated, so licensed MTF that's passed through Gate 1 of the UK's digital security sandbox. And again, both of these projects are really standing at the sort of the cutting edge of what it means to be using blockchain technology within the institutional space in a fully regulated, compliant fashion, and really, I think, um, shows what the shape of things to come are going to be as a result of the combination of innovation on the one hand, but the evolution of regulations to accommodate that in a safe and secure fashion with effective protection for investors.
I think what strikes me most here is that a lot of work, a lot of great work, hard work is happening behind the closed doors. And then, when we see all these announcements, they just come out of a sudden of nowhere. But then we understand that, there's been maybe years that those institutions have been working on a particular initiative and really been pushing through, which is, again, proves your point multiple times. And going back to what you were saying, I completely agree that it should be really a top-down approach, when it comes to, for example, DTCC pilots and similar initiatives, because, again, there are large incumbent players that are kind of controlling a particular market, a particular segment, particular function, but then those broad initiatives for retail users totally makes sense as well, right? They just accommodate different user categories, different interests, different demands. But the amazing thing about this space is that I truly believe they will at some point converge. And this is what we're all looking forward to. But David, thank you for again bringing up those practical use cases. And we've also touched upon this very recent news on the launch of OpenUSD, right? The new global stablecoin. So do you see it as a logical consequence of the advancement in the regulatory space, and just generally maybe a broader dialogue between different market participants? That's one question. And the second question is just your general assessment of the initiative. What are your expectations, and how successful could it be at all?
Well, I think that there's two ways of looking at it. One, which is um, it has a very impressive set of names associated with it. So that would potentially mean a really solid distribution network if you can convert those names into active participants within the consortium. I think the other challenge that you have is that though that is it is a consortium, and consortiums are difficult. The larger they are, the more difficult they are to actually get aligned and execute. So that is a so both a benefit and obviously a challenge as well when it comes to execution. But the payment space is just enormous. So we talked earlier about there being um, a market cap for stablecoins of 300 billion, uh, but that pales into insignificance when you compare it to the trillions of dollars of settlements that are of payments that are being conducted by the likes of JP Morgan on a daily basis, or the Swift network on a daily basis. So I think that that there's still an awful long way to go, and therefore a lot of opportunity for the technology in the payment space, and therefore I look with quite a lot of optimism around these initiatives, and in terms of their opportunity to actually to be successful, especially as we look at different models to incentivize participants around, um, how the economics around the reserves will work for these for the participants, or specifically sort of what use cases are they targeting? And it could well be that there is that well, given the size of the space, the size of the potential market that everyone's going after, I think that there's lots of opportunity there for multiple participants, um, despite the tremendously impressive achievements of the likes of Tether and Circle so far as their implementations of stablecoins.
Can we actually put it a bit more into perspective in terms of timelines? And I'm also very curious about the cost to companies to, build out these integrations, and obviously also the cost of pushing through these projects, because as you said, it needs quite substantial involvement from the headers or leaders of the company. There's a lot of legal questions, a lot of departments involved to actually get these products working. So maybe like a two-pronged question that, what is the actual cost to company for an institution or a bank or, whatever market participant you'd like to give as an example?
Mm.
And second of all, what timelines are we actually talking about in terms of, for example, when you say that there's such a huge opportunity ahead of us? Are we talking 2 years, 5 years, sort of when we could see a more mature state of the market?
So I think that it depends on what we're looking at in terms of the opportunity. So the tokenization and the transformation of the institutional space, say for instance, real world assets being tokenized and put on chain. Um, the expectation that that is going to take anything other than decades, I think actually is a little uh, naive. The existing rails um, are highly efficient and highly optimized and deeply embedded uh, in within capital markets. Uh, and I think at the very least we'll see that the blockchain rails and traditional rails will exist side by side for many years to come. So I think that will need to be the case for both legacy assets, legacy participants, legacy processes, and so on. So we're not about to see in the next 10 years a wholesale transformation of capital markets and a move on chain. I think you'll see an increasing amount of activity happening on chain, but the most critical aspect of what will be occurring will be the interaction between these two technologies. So the the biggest challenge that we had to overcome when it came to the sort of technology adoption within at six at SDX was that the technology had to interoperate with the existing infrastructure. So the initially we built bridges between the blockchain infrastructure and the traditional infrastructure so that assets could settle on both. And then ultimately, we actually, this was completed earlier this year, uh, brought the DLT and the traditional infrastructure underneath the same license. So I think that interoperability is absolutely critical when it comes to the adoption of this technology. So these will need to not just sit side by side, but have really efficient connectivity between them, the blockchain infrastructure and the traditional financial infrastructure.
David, and to conclude this really interesting conversation, may I ask you to name a single institution, a single company, maybe a bank or whoever, that you're really closely monitoring and that you think is doing very impressive job in terms of institutional adoption of stablecoins, tokenization mechanisms, and just broader blockchain technology adoption?
Oh, that's so a single institution. Well, I would have to take my hat off to Six for what it achieved in terms of the first regulated financial market infrastructure on blockchain technology and the first digital bond issued on regulated financial market infrastructure and the first implementation of that bridge and the first settlement in wholesale central bank digital currency. That all happened in Switzerland at Six. So I'll clearly always be loyal to my previous employer when it comes to what they achieved. But I if I look at the outside of Switzerland more broadly, um, I think you can't ignore the strides and the pioneering steps that Standard Chartered has made over the last few years. It's always been at the forefront of adoption when it comes to digital assets. So they have the first GSIFI that's going to have that had a crypto spot desk and a prime brokerage function. I think that was very much sort of leaning forwards when it comes to the adoption of this technology. But um, there are slow but steady innovation examples. I think slow is the wrong way of putting it. Like I think an inexorable move in the right direction by organizations like JP Morgan and their Connexus product. So they've been conducting trillions of dollars of settlement on blockchain for years now, and they've really sort of shown what it means to leverage the technology in a fully regulated, safe, compliant fashion. So I know that the JP isn't always sort of the friend of, seem to be the sort of public friend of crypto, but I think that they're deeply impressive in terms of what they've achieved over the years in terms of genuine usage of the technology. And then looking more broadly, um, I think that the DTC, which I've mentioned several times now, DTCC and the Nadine Chaka has been a real light in this space. They've been very vocal about driving forwards the tokenization agenda, and I think given the scale that they represent, uh, their plans around tokenization could be absolutely transformative for capital markets and for the adoption of tokenization by the institutional space.
Right. So our listeners should then be also closely monitoring the progress of SDX, Standard Chartered, JP Morgan, and ultimately DTCC as well. And then, yeah, the picture is very broad. A lot of institutions are showing real progress, and it's just amazing to be part of this space. David, thank you so much for spending this time with us today.
It was a pleasure. Thank you very much indeed, Leica and Kaisha, for your time.